Welcome to This Explainer. You know, for years, financial technology, or Fintech as we all know it, was basically the Wild West. It was driven by this incredible speculative exuberance, massive venture capital hype, and a pure growth-at-all-cost mentality. But the dust has finally settled. The sector has officially crossed into a maturing, post-hype era. So today, we're going to deconstruct the blueprint for what industry experts are calling the fifth age of fintech, drawing our insights directly from a comprehensive new report by McKinsey & Company and QED Investors.
Okay, let's dive into this roadmap. First up, we'll look at the sheer scale of the fifth age. Second, AI's four financial horsemen. Third, digital assets finally grow up. Fourth, the dash for banking licenses. Fifth, the rise of horizontal fintech. And finally, we'll wrap up with new recipes for success. Section 1. The fifth age of fintech.
$650 billion. That's the projected total global fintech revenue in 2025. Now, to put that massive number into perspective, the financial apps on your phone and the digital plumbing running behind them are now generating more revenue than the entire GDP of countries like Norway or Singapore. Growing at roughly 21% year over year, fintech is no longer just some speculative experiment. It's a massive, load-bearing pillar of the global economy.
But here's the truly fascinating contrast. Despite pulling in that staggering $650 billion, fintech companies have only managed to capture a mere 4% of total global financial services revenue. Think about that for a second. That means 96% of the money out there is still locked up by traditional legacy banks. So yes, the industry has absolutely come of age, but the ceiling, it is nowhere in sight. The runway for growth here is literally massive.
So how exactly did we get here? Well, we started out with the basic digital pioneers back in the 90s, and then moved into an era of rapid growth, where acquiring users mattered way more than actually making money. Then, of course, we hit that massive VC hype surge of 2021, when it felt like literally anyone with a decent pitch deck could raise millions. But as interest rates shot up, we slammed into the Great Reset of 2023. It was a sharp, pretty brutal contraction that ruthlessly weeded out weak business models. And that brings us to today, the fifth age, a mature return to growth that's focused on actual sustainable profitability.
Section 2. AI's four financial horsemen.
So AI is acting as the supreme accelerant right now, systematically tearing down the old financial moats through what we can call the four horsemen of financial services. First, you've got commoditization. AI writes codes so fast now that unique products are copied in days, not years. Second, democratization. AI is making high-end personalized wealth advice accessible to everyone, rather than just the ultra-rich. Third, disaggregation. AI is breaking apart those old bundled products, letting consumers optimize their credit cards and loans completely separately. And finally, disintermediation. We're talking about AI agents, smart bots acting on your behalf that could very soon negotiate directly with banks for you, completely bypassing the traditional customer relationship.
And this dynamic is forcing a brutal market bifurcation. On one side, you have the pioneering incumbents and AI-first disruptors. They are harnessing this tech to build out products in weeks that used to take years. But on the other side, you've got the slow movers. By failing to integrate AI quickly, they are risking severe margin squeezes and progressive irrelevance. Honestly, they're going to be left in the digital dust. Relying purely on a cool product feature to defend your business, that's a losing battle today.
Section 3. Digital assets finally grow up.
The center of gravity in the crypto world is finally moving away from speculative trading on the fringes right into the core operations of major banks. The true, lasting value is now all about tokenizing real-world assets, basically putting traditional money and bonds onto a blockchain. Now, why does this matter? Because it solves massive settlement problems. For a multi-billion-dollar bond trade to settle instantly, the cash has to move at the exact same speed as the asset. Tokenized bank deposits give institutions that secure, highly regulated digital cash, allowing for instant 24/7 settlement without the money ever having to leave the safety of the traditional banking system. It's a real game changer.
But we do have to be realistic about where this technology actually stands right now. You might see headlines out there boasting about $35 trillion in annual stablecoin volume. Sounds incredible, right? But when we break those numbers down, a staggering 99% of that volume is just automated trading, arbitrage, and technical blockchain activity. Only 1%, which is roughly $390 billion, represents true end-user payments, things like paying suppliers or sending remittances across borders. So the tech is absolutely revolutionary, but real-world adoption, it's still in its infancy.
Section 4. The dash for banking licenses.
21. That is the total number of U.S. banking charter applications filed by fintechs in 2025 alone. Just to put that into perspective for you, that is more than the previous 4 years combined.
It's a massive, and honestly kind of ironic behavioral shift. After years and years of viewing strict banking regulations as the ultimate enemy of innovation, these disruptors now actively want the massive regulatory scrutiny of becoming an actual bank.
So what's driving this? Well, scaling fintechs have realized that regulation is actually a strategic weapon. First off, it dramatically lowers their funding costs by giving them access to your everyday checking deposits, instead of forcing them to borrow expensive money from other institutions. Second, they gain deep control over the value chain, so no more renting infrastructure from partner banks. Third, they can expand into huge, lucrative areas like mortgages. Ultimately, becoming a fully chartered bank reinforces their defensive moats and gives them outright ownership of the one thing that really matters: customer trust.
Section 5. The Rise of Horizontal Fintech.
While the flashy consumer apps are the ones grabbing all the headlines, there's a totally new breed of companies rewiring this industry right behind the scenes: horizontal fintechs. Think of them as the picks and shovels of the modern financial gold rush. These are B2B software providers that don't actually offer services to you directly. Instead, they provide the AI risk decisioning, the identity verification, and the modern software that legacy banks absolutely desperately need to survive and upgrade the apps on your phone. They aren't directly competing with the banks. They're acting as these invisible ecosystem enablers.
And let me tell you, the smart money has absolutely noticed this shift. Back in 2021, horizontal tech solutions over in UK InsurTech received just 25% of funding, while the rest went to those flashy consumer brands. Fast forward to 2024, and a staggering 91% of all funding shifted to these behind-the-scenes enablers. And this brilliantly illustrates the new reality. Investors have realized the true, hidden winners of this era are the software companies building the critical infrastructure that everyone else has to rely on. Section 6. New Recipes for Success.
The industry has fundamentally recentered itself. That old recipe of growth at all costs, it's completely dead. Today's baseline requires a very strict balancing act. You still have to demonstrate high scalable growth, sure, but you absolutely must have credible unit economics, meaning you actually have to make more money on a customer than it costs to acquire them. Add in mature compliance and flawless distribution, because if you don't have a clear, realistic path to actual profitability today, the market will simply no longer fund you. It's as simple as that.
I think this quote from Raman Bhatia of Starling Bank hits the nail on the head. He says, "Technology barriers are coming down, but business model barriers are going up." What he means here is that in a world where AI can help practically anyone code a sleek new app in a matter of weeks, your software features alone are no longer enough to protect your business. A pretty user interface is not a moat anymore. Your advantage now relies entirely on deep, flawless operational execution and robust customer distribution networks.
Which leaves us with one final, vital question to ponder. In an age where AI can build a product in weeks, do you own the customer trust required to survive? Whether you're a massive legacy bank or a rising disruptor, product quality still matters, for sure. But trust and distribution? Those are the ultimate moats. Whoever owns the customer relationship will absolutely dominate the fifth age. Thank you so much for joining me on this explainer, and definitely keep questioning how these invisible forces are shaping the money in your pocket. See you next time.